Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me to discuss what SPACs are, how they are different than IPOs, and the outlook on capital raising are Daniel Newson, Joel Ropenstein, Jonathan Rockwager, and Elliot Smith with White and Case. Gentlemen, it's great to have you with us on Trade Talks. And Jonathan, I'm going to kick it off with you for a high-level overview on what a SPAC is.
Thanks, Jill, for having us. Nice to be here. So a SPAC is a blank check, or more technically, a shell company formed for the purpose of completing a business combination with one or more target businesses. SPACs are formed by sponsors with experience that allows them to identify and complete a business combination with a target business that ultimately will be a successful public company. We've been seeing high quality sponsors, including private equity funds, venture capital funds, hedge funds, financial institutions, and some very experienced operating executives and strong management teams form SPACs recently. Some SPACs focus on a particular industry or industries, while other SPACs have no specific industry focus. So a SPAC conducts an IPO to raise capital, and the cash raised in the IPO is placed in a trust account and is not released until either the SPAC completes a business combination or some specified outside date occurs, the liquidation window, which is typically 18 to 24 months after the IPO closes if the SPAC fails to complete a business combination by that date, although that period is sometimes extended. SPACs sell units in their IPOs, with each unit comprised of one share of common stock and a full warrant or a portion or a fraction of a warrant to purchase one share of common stock. Interestingly, we recently have been involved in a couple of SPACs in the life sciences space where there was zero warrant coverage, where the SPAC sold only shares of common stock without any warrants, which is obviously much more advantageous to the SPAC from a dilution perspective, and which makes the SPAC much more attractive to potential target businesses. But to be clear, that's been limited only to the life sciences sector. In connection with the SPAC's stockholder vote to approve its business combination, as part of the hallmark feature of a SPAC, the SPAC's public stockholders are entitled to redeem their shares for a pro rata portion of the cash raised in the IPO and held in the trust account. And at the closing of the business combination, the balance of the trust account, net of any of these redemption amounts, is released to be used in the business combination transaction and or by the combined company post-closing for working capital purposes.
Joel, what are the benefits to a sponsor for forming a SPAC?
So there are a number of benefits to sponsors in forming SPACs. A sponsor forming a SPAC is able to access capital from public investors. So that's something that if they were to do a private fund, they would not be able to do. They may have a lot of deal flow that they're seeing, but don't have a platform in which to monetize it. So this provides a platform for them to be able to do that. Obviously, they're in it to also benefit from the growth and the upside that can come when they consummate a business combination. And so the SPAC sponsors typically get 20% of the stock of the post-IPO company. And they also put in risk capital, which also could be very lucrative if they consummate a business combination. And the idea of a SPAC sponsor is that they really want to partner together with a management team to create a great company. So they're bringing a vehicle that has the capital and has their expertise and their experience, and then they find a great company to combine with, and together they're able to really create something more than either of them could have done. And everybody benefits. The shareholders of the target benefit and the sponsors benefit. And if they're successful, there's also the opportunity to do serial SPACs. So we've seen many SPAC sponsors create not just SPAC 1, but SPACs 2, 3, or 4. And now we're starting to see people actually do multiple SPACs at the same time, typically with different sizes or also potentially different sectors that they're focused on.
Daniel, what current trends are you seeing with SPAC IPOs?
Thank you. So if it wasn't kind of obvious enough in looking around, the first big trend we are seeing this year is just sheer volume. There are many more SPACs than we've really seen in any other previous year, and many SPAC sponsors are going out with mega size SPACs, upwards of $1 or $2 or even more $billion. One of the very prominent trends we're seeing are household name sponsors are forming SPACs. So we're seeing folks sponsor SPACs who may not have considered the product in prior years. And that's been an exciting development in the SPAC space to see it really accepted into the mainstream. Another big trend we're seeing is really a broad range of sectors being targeted by SPACs. While a SPAC can go out with really no focus at all in terms of sector and they're just looking for a good company to partner with, we're seeing SPACs specifically go out targeting industrials, healthcare has been hot, entertainment and media, technology, including biotech, and even socially conscious and ESG or environmental, social, and corporate governance focused SPACs. We've heard from underwriters who we've worked with many times on SPAC IPOs that the investor base has potentially shifted a bit away from what we would call kind of serial SPAC investors, a number of funds who historically have looked to SPAC IPOs as investments, to more fundamental investors who are interested in holding the SPAC securities from the IPO through the eventual business combination and really going along for the journey with the SPAC sponsors and being open to holding for a long period of time. We've also seen some potential openness to acquiring target businesses that may be in earlier stages of development, which we didn't necessarily see in SPAC business combinations in prior years. And this year, with so many prominent names sponsoring SPACs and so much volume, we've also seen really sponsor favorable terms take a hold, particularly in larger SPACs. So as my colleagues mentioned, a SPAC IPO consists of a unit and the warrant included in the unit. We've seen a lot of downward pressure on what public investors are able to receive in terms of a fraction of a warrant. We've also seen with low interest rates that sponsors really aren't able to use interest earned on those assets for working capital purposes, but really have been focusing more on kind of this zero interest rate environment and seeing what we can get in terms of early opportunities for business combinations rather than what is the interest income going to do for shareholders.
And Elliot, why would a company choose to go public through a business combination with a SPAC versus an IPO?
Well, for a number of reasons. Principally, I would say that there are factors in a SPAC business combination process that make it easier and perhaps less arduous for the target company to go public. There's an ability to go public during periods of market instability. So in cycles where we've seen the IPO market essentially shut down, SPAC business combinations have still been able to get done. There's an ability of existing owners of the target company to take more cash off the table than in a typical IPO where investors are expecting a significant rollover of current owners. And then certainly the ability to market a SPAC business combination is quite different from an IPO in that in a SPAC business combination, projections are almost always used in the marketing materials, and whereas in an IPO prospectus, those are not available. And that really allows for flexibility in management being able to tell the story of the business, as well as to price the business combination of the company based on a forward multiple as opposed to historical performance. The other thing about SPAC business combinations is that they're very flexible vehicles for companies to go public. And an example of that is the recent DraftKings transaction that we worked on, where DraftKings wanted to scale its business and needed to make an acquisition in order to do that, but it also wanted to go public. And so by entering into a business combination and a simultaneous acquisition, it was able to both acquire a company and go public at the same time and use that to scale its business in a way that it would not have been available to it in an IPO. The last factor that I'll mention is the ability to structure the transaction to bridge any valuation gaps that may exist between how the sponsor or the public is looking at the target company and the sellers, how they view the target company. And there's an ability to build in earnouts into the valuation that is not available in a traditional IPO context.
All right, and Joel, to wrap up here, where does White & Case fit into the SPAC ecosystem?
So we fit right in the center of it. We're extremely active. Our team has worked this year on 22 SPAC IPOs, including 15 on the SPAC side, and the rest on the underwriter side. We also represent a number of institutional investors in investing in SPACs through a variety of different structures. And on the business combination side of it, it's a real strength for us because White & Case has a great M&A platform, and that platform is really able to be brought to bear in our SPAC business combination transactions. We have a number in process right now, a number in the technology space that benefit from the support of our technology transactions practice. And thankfully, we've been involved in a lot of good ones, which are trading pretty well right now. And that's, of course, great for the IPO side when transactions trade well. And also, crucially for us at White & Case, the international capabilities. We've done a lot in Asia, and in particular right now, working on a number of SPACs being sponsored out of Greater China with some very, very prominent sponsors. And that also, again, brings the strengths of our firm together, the cross-border capabilities. And we're also looking at a variety of things right now in Europe. So we're able to seamlessly work on those types of transactions using the White & Case platform. So, we're very fortunate to be right in the center of things. It's a very important practice for our firm and our capital markets practice overall. And we look forward to continuing the rest of the year strong. We see a pretty strong pipeline, a very strong pipeline, in fact. And I just want to thank you again for having us today on Nasdaq Trade Talks.
All right, and thanks for joining us. It's certainly encouraging to hear about the pipeline. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.